Okay, LLC taxes for beginners. I have my iPad ready. Hopefully you're ready. Let's get into it. So this is going to be a clear step-by-step guide on everything dealing with taxes and LLCs, all right? We're going to be going over a lot today, but if you get this, then by the end of it, you'll have a concrete understanding of LLC taxes, right? So we're talking about LLC basics. We're talking about default taxation, taxes LLCs owe, when and how LLC taxes are paid, optional LLC tax elections, reducing your LLC tax burden, and then lastly, but not least, LLC tax mistakes. So with all things, it's usually best to start with the basics. So let's go there first. What is an LLC? Well, an LLC is a business structure that protects your personal assets while keeping flexibility in taxes. And that's one of the reasons people love LLCs, because of those two things and not any one thing, right? It protects your personal assets, but at the same time gives you flexibility in taxes, right? And that's important here. But in general, an LLC stands for limited liability company. It separates your personal and business liability, offers flexible taxation options, as we mentioned, and you can have a one owner LLC, or you can have multiple owners, 2, 3, 4, however many the owners are called members. So what types of LLCs are there? Well, we kind of already touched on it a little bit, right? There are two types, and it depends on the number of owners. A single member LLC has one owner. A multi-member LLC has 2 or more owners. Same legal shield for both, right? Just different tax filings. That's the key difference. So why don't LLCs pay taxes directly? Well, the IRS actually ignores LLCs unless you tell it otherwise, it being the IRS. The default option for LLCs is to be a disregarded entity, meaning that income flows to the owners. Tax is collected from people, the owners, not the LLC itself. That's why elections exist later, tax elections. All right, so let's talk about the default taxation rules for LLCs. Well, LLCs get taxed like simpler businesses by default, right? So a single member LLC gets taxed like a sole proprietorship. A multi-member LLC gets taxed like a partnership. Both slow, profits due to the owner's tax returns, but those are the differences, right? Single member, sole proprietorship, multi-member, partnership. That's the default classification for the IRS when it comes to taxes. So let's go over it in a little bit more detail. For multi-member LLC, once again, it's treated as a partnership. So you file your 1065, the IRS does not tax the LLC directly, and each owner receives a K1, right? That shows the profit and loss for that particular member. So how do multi-member taxes work? Well, each member pays on their share, distributed or not, right? So whether they keep money in the company or disperse it to the owners or distribute it to the owners, you still get taxed on it, right? So that's both self-employment tax and income tax. All right, profit is taxed whether you withdraw or not, and there's no avoiding the tax by leaving it in the business. Not with a LLC as a default. All right, so let's talk about pass-through taxation. Well, pass-through taxation is simply the fact that the profit and loss passes through directly to the personal tax return, right? Profits appear on owner's personal return, and it avoids the double taxation corporations face, even though corporations can keep money in. And well, okay, I won't even get into that yet. We'll talk about that. So let's talk about the core taxes that LLC owners face. Well, LLCs are only taxed on their net profit, right? That being income minus deductible expenses is your taxable profit. Once again, it's profit is taxed whether you withdraw it or not. I have to make that clear, all right? I just have to make that clear. And owners, not the LLC, write the check to the IRS. The owners do. So what taxes actually apply to the owners? Well, they face three main taxes. The first one is self-employment tax. That's Social Security and Medicare. The second one is federal income tax based on their tax bracket. And the third one is state income tax in many states. Some states don't have state income tax, but most do. So let's go a little bit more into detail on self-employment tax, because you pay both halves of self-employment tax, that being Social Security and Medicare. And that tax is a flat rate at 15.3% of net profit, not your gross profit, 15.3% of net profit. So that covers the employer share and the employee share, right? Because you're basically acting as both. And every self-employed owner owes it, unless you do what we're going to talk about a little bit later in this video. But let's go over an example with real numbers. So let's use 100K profit. And on 100K profit, your self-employment tax alone is $15,300, right? Because 100,000 times 15.3% is $15,300. But that's not all your tax, because you still owe income tax on the full 100K. All right, so you can see how that burden adds up. You have this plus this to pay in taxes. So let's look at the true total tax load. Well, LLC owners often lose 25 to 40% of profit simply to taxes. Man. And self-employment tax plus income tax together equals the real cost. And most LLC owners forget that, especially self-employment tax. They completely forget that a lot of times. Right? So many owners underestimate that. And planning for it is the only way to reduce it. Right? You have to know it's coming. You have to get ready for it, save for it, and get ready to pay it. So speaking of payment, let's talk about when and how taxes must be paid. So LLC owners pay as they go, not once a year. So LLC owners pay as they go, not once a year. So what does that mean exactly? Well, the IRS requires quarterly estimated payments. No automatic paycheck withholding, like W-2 employees get. Of course, it's not that easy. So you must plan for your own cash flow. But what are those quarterly deadlines? Well, there's four that you need to keep in mind. We have April 15th, we have June 15th, we have September 15th, and we have January 15th. Right? So we cover the year's taxes in installments, 4 installments, right? And missed deadlines trigger penalties. So who is required to pay these quarterly taxes? Well, most LLC owners must pay quarterly taxes. All right? Especially, here's a little trick, right? This is going to be a little off topic, but here's a little trick. The people who don't have to pay this quarterly are the people who reduce their taxes to zero for the previous year, right? So your quarterly taxes are based on what you made last year, what shows up on your return. So you don't want quarterly taxes the year following? Well, you have to reduce your taxes to zero, or at least as much as possible. And that'll reduce your quarterly taxes moving forward. That's just a little tip there. But let's get back to it. So once again, most LLC owners must pay quarterly taxes. And the rule there is that if you owe more than $1,000 in taxes, well, then you got to pay. Almost every profitable owner qualifies, as I mentioned, And paying avoids a painful year-end bill. Once again, you have penalties and interest. So how do you calculate those payments? Well, you estimate your profit, apply a tax rate, and divide by 4. So you estimate annual income and deductions. You apply self-employment tax and income tax, and then you divide that total by 4 quarterly payments. But we can't forget about state taxes, right? And there are 2 ways that states tax LLCs. Some charge a flat annual fee, which is called a franchise tax. Others add income tax on the profit. But the rules vary widely from state to state to state. Some states don't charge at all, right? But let's look at some specific state examples. California is going to right? Is going to charge you $800 minimum as an annual tax. Texas has gross receipts and franchise tax. And Florida has no state income taxes at all on LLCs. But once again, it varies widely from state to state. All right. Now, how to pay the IRS? Well, you pay them online or by mail. And the most important thing is that you just keep records. For most people, their tax preparer or CPA will do this for them. But if they don't, then this is how you do it. So we have the IRS Direct Pay, which is the fastest and what most people use. Or you have the mail-in form with a check. But you always want to save your proof of payment. That's going to be important there. So what happens if you miss a payment? Well, we know it can't be good, right? So let's look at it. The IRS charges extra if you're late or you're short. So if you're late, you have 0.5% per month up to 25%. That makes me scared just thinking about it. I don't even like it. And if you underpay, you have additional penalties. But exceptions do exist for hardships or uneven income, right? So if something happens in your life, that's considered a hardship, and you just don't have the money where you can go on a payment plan, and the IRS will work with you in most cases to pay that tax burden off within the next year or a couple of years. All right, so let's look at the big picture of the LLC tax options. Well, there are 3 tax lenses, right, that I want you to look through when you're thinking about LLC taxes. The first lens is the default lens, right? We talked about that. That's pass through, and that's whether you're going to be looked at as a sole proprietor or partnership in the eyes of the IRS. The next lens is to elect S-Corp taxation. And the third lens is to elect C-Corp taxation. So let's talk about each one. When, why, how. Okay. So an LLC can be asked to be taxed like an S-Corp, right? You just file Form 2553 with the IRS to do so. This allows you to have a salary plus distribution split, right? And that split helps you to cut off your self-employment tax burden, right? So let's talk about exactly how that's done. So when it comes to S-Corps, only your salary gets hit with self-employment tax. So your wages are the ones that are subject to self-employment tax. Your distributions are not subject to self-employment tax. So overall, your tax burden can drop significantly. So let's look at some numbers behind it. Well, let's say you have $100K profit as an S-Corp, right? Your salary, you make $60K. And generally that is based on your title, what you do, and the market rate for what you do. That's how you should determine your salary. But in this case, let's say $60,000, right? That $60,000 will be taxed with the self-employment tax of 15.3%, giving you a tax of $9,180. Your distributions, however, that $40K left over, that's not salary, has no self-employment tax, which means that you have a tax savings of nearly $6,000. What? Yep. So that's why people love S-Corps. All right. So when does it make sense to become an S-Corp? Because it doesn't make sense for every LLC. In fact, most LLCs, it likely doesn't make sense for, and I'm going to tell you why. So S-Corps work best once profits pass 50K. Why is that, Karan? Well, that's the case because under 50K, the savings you get from moving to an S-Corp does not surpass the administrative cost and the administrative burden, right? So it works if you're willing to run payroll, right? It works if you're willing to go through the extra filings. It's a smart step for growing businesses, but you have to be at that 50K number. Anytime before it, it's gonna waste your time, and you're just gonna have way more paperwork, way more things to keep track of. Just trust me. But that's not the only option, right? You also have the C-Corp option, which a lot of people don't talk about. So let's talk about it. An LLC can elect to be taxed as a C-Corp. They file Form A832 with the IRS, and when you are taxed as a C-Corp, well, those profits are taxed at a flat 21%. That's the corporate rate. Your dividends are taxed again. That's double taxation that comes with being a C-Corp. So that doesn't really sound appealing to a lot of people. But let's see when C-Corps may help you. Well, C-Corps fits high growth or reinvestment heavy companies. They're best if profits are reinvested, not withdrawn, right? So it's good for that. You get great access to health insurance and retirement perks by being a C-Corp. And it's just a great long-term strategy for scaling your business. Once again, best for high growth companies or companies that reinvest heavily. They want to be C-Corp. So what are some ways to reduce taxes? I'm just going to tell you right now, this is my favorite part. Maybe you like paying taxes. I don't know, but I don't. Okay. So I love this part on how to reduce the taxes. So let's talk about it. So there's two ways to lower your taxes. So here's the framework. Here's the lens that I want you to look at this through. You reduce your taxes by either lowering your profit or shifting it, right? So you reduce your profit with business deductions, all right? You shift, well, deductions, let me say, and credits, all right? You can't read that, but it says credits. Or you shift profit with strategies like tax selection, like we talked about, family hires, retirement, so on and so forth. And both of those options keep money in your pocket legally. So let's look at some common deductible expenses, right? And let's throw some credits in there too. So any ordinary and necessary expense can shrink your taxable income. So deductions like the home office deduction, right? The mileage deduction, you buying supplies, you having subscriptions, online subscriptions for the things you need to run your business. Those deductions help shrink that taxable income. Now, credits, on the other hand, like the work opportunity tax credit and the R&D tax credit and so many other tax credits, also help you do the same thing, but there's a difference between a deduction and a credit because every dollar deducted lowers your profit, your taxable income. But every dollar credited lowers your actual tax liability. So credits are actually worth, in some cases, a lot more than deductions, but you want both. If you and try to find both, as many deductions, as many credits as you can to lower that taxable income and to lower your tax burden. So let's talk about using retirement to save on taxes. Not only does it save on taxes, it allows you to build wealth. So things like your solo 401k or your SEP IRA for owners, right? Because those contributions reduce taxable income now and they grow tax free or they grow tax deferred, not tax free, for future use. All right, we have some other creative strategies though. There are many other deductions, many other credits, and strategies that you can use to lower your taxes. So what I want you to do is go to keepmost.com. That's KEEPMOST.com. It's a platform with every credit, every deduction, every strategy specific to your business, income, situation, personal details. The same details that your CPA would give you, same strategies, right, are here. And it's not live yet, but it's releasing soon. So you can join the waitlist and get a discount for it right now if you're serious about lowering your taxes. All right, so let's look at some common mistakes to avoid. Mistake number one, as we talked about, is ignoring self-employment tax. Simply forgetting that there is a self-employment tax creates a nasty, nasty, nasty surprise. Many new owners underestimate it or simply forget it, which leads to IRS bills they can't pay. So many stories of this. So always plan for it up front. That's what I want you to do. Plan for that self-employment tax. And better yet, plan for deductions, credits, and strategies that allow you to not have to pay taxes at all. But anyway, let's go over mistake number two, which is not paying your quarterly payments. Right? So when you skip those quarterly payments, it costs you twice. It costs you with penalties, and it costs you with interest added to that tax bill. All right? So which leads to a big year-end crunch for owners. So you want to use your calendar reminders to stay compliant there. And all these and deadlines like quarterly payments are also within Keep Most as well. So that's just a plus there. All right. Let's look at mistake number three. It's mixing business and personal assets. So mixing money destroys both tax clarity and liability protection. Why? Because the IRS and courts treat it as piercing the veil, right? They're not separate anymore. You and your business are not separate if your assets and the money and the transactions all commingle with one another. So it creates bookkeeping chaos and loss deductions, as well as lowering your liability protection. So you always want to use separate accounts for your business and your personal life. All right, mistake number four is poor record keeping, right? So bad records equal lost money and higher audit risk. So lost receipts means lost deductions. Inaccurate books trigger IRS red flags. So you're going to want to use bookkeeping software or hire help. Okay. Mistake number five is forgetting required IRS forms. So missing filings can undo all your tax planning. So here are the things you must file. Multi-member LLCs must file a Form 1065 plus a K1. S-Corps need to file Form 2553 plus payroll reports. Late forms equals penalties and loss of tax status in some cases. So wrapping it all up, all right? What did we learn today? Well, we learned that LLCs don't pay tax directly, their owners do. We learned that the default tax status is a pass-through tax on profit, that owners pay self-employment tax and income tax, and there are 3 tax lenses plus 2 saving levers to give you options to pay less taxes. So here's the key takeaway. LLC taxes look complex, but they follow a system. So you learn the rules, you pay quarterly, and you use strategies. Your taxes shrink when you plan for it, but not when you guess. And you want to treat your LLC like a business and not a side hustle. So keep good records. Stay on top of details and deadlines. All right? The small things. And the next thing that I want you to do is that if you need help with LLC Tax Strategy, like I mentioned before, I've been working on something extremely special for our YouTube family. It's a tax credit and tax write-off platform called Keep Most. And once again, we baked in all of the tax strategies, the deductions, the credits, the income shifting strategies, the entity strategies, so on and so forth. Right? The same things that your CPA or the best CPAs will provide for you. We baked it into a platform for less than $2 a day. So I want you to go and sign up for the pre-launch with the first link in the description. And if you do, you'll get a discount for when we go live in like 30 days. Please do, because this is going to be a very, very good option for a lot of people to get this type of insight, especially for their personal situation. All the businesses that you run, their expenses, your personal life, kids, no kids, wife, no wife, healthcare, no healthcare. First link in the description. And with that, my name is Karan. Thank you for watching, and I'll see you in the next video.